We're breaking into question time to bring you special coverage of the looming interest rate decision. States on the East Coast can continue watching Question Time on ABC TV. Other states can watch on ABC iView. I'm Ros Childs. In a matter of minutes, we'll learn whether interest rates will rise and if so, by how much. Experts are tipping the RBA will increase rates for the fourth consecutive month due to rising inflation. It is another hit to the hip pocket of thousands of borrowers, many of whom didn't expect such a rapid rise so quickly. We'll have comprehensive coverage of the decision and what it'll mean for you. Our senior business correspondent Peter Ryan is outside the Reserve Bank in Sydney for us, and finance reporter Alicia Barry is with me in the studio. Hi to you both. Can I start with you, Alicia, then, first of all? Obvious question, what are we expecting in a few minutes' time?
Well, the majority of economists that have been surveyed by both Bloomberg and Reuters are expecting a 0.5 percentage point increase, which would take the cash rate from 1.35%, where it was in July, to 1.85% today. That would be the fourth increase in a row and the third 50 basis point or 0.5 percentage point increase in a row. And it really is a big jump from the record low emergency settings that we saw during the pandemic, where the cash rate was sitting at 0.1% to taking it up to almost 2%. It'd also be, if it was at 1.8%, the highest cash rate since April 2016. Now, markets are expecting the cash rate could go as high as 3.3% by early next year, around March, before falling back as the RBA is forced to cut to around 3% at the end of next year. But there's a lot of factors for the Reserve Bank to take into account. At the moment, aside from consumer sentiment, the economy is still performing very well. We've got unemployment at its lowest level in 48 years, sitting at 3.5%. We do have inflation as a problem. It's running at 6.1%. The Reserve Bank would like it between 2 and 3%, but a lot of that inflation is coming from overseas. It's being brought into the country because of supply chain issues, being the war in Ukraine pushing up energy and grain prices, and also the supply issues associated with the floods, which has crimped fruit and vegetable production. The key issue for the Reserve Bank really will be wages growth. If that rises significantly when we get the quarterly data in 2 weeks' time, it might put more pressure on the Reserve Bank to keep this really aggressive interest rate hiking cycle going. Some economists, though, are asking the Reserve Bank to take pause and see how these rates play out in the economy because of the impact it's going to have on the highly indebted consumer sector. So we will wait and see what we get today and then take some analysis based on what the RBA has to say.
Let's turn to our senior business correspondent, Peter Ryan, who's down outside the Reserve Bank there. Hi, Peter. So there had been talk of a rate rise of 0.75%. That seemed to be on the cards a while ago, but then we had the latest inflation numbers, which came in slightly softer than expected.
Yeah, that's right, Ros. Before we saw that 6.1% inflation figure, it was looking as though the Reserve Bank might go for a supersized rate hike of 0.75. Some economists even talking about a full percentage point. But because inflation came in at the lower end of expectations at 6.1%, it looks as though the Reserve Bank will continue going for these 0.5 percentage point increases, which is important for anyone watching this, anyone who has a mortgage, anyone who's getting a personal loan or a car loan. All of this is very important, and as Alicia mentions, it's coming down to how fast, how aggressive does the Reserve Bank want to go in raising these interest rates? How far will they push it in that pursuit of a 3.3% cash rate, having to finally calibrate it without damaging the economy or crashing the economy in some ways by cooling it too quickly. And there are already expectations that the Reserve Bank might actually be in a position to start cutting rates by mid-2023.
So this will be the fourth rate rise in as many months, Peter. The bank always releases a statement with its rates decision. What should we be looking for in that document in terms of what the Reserve is thinking?
Well, these days the Reserve Bank communicates very clearly. They put the outcome right at the top of this document. We used to have to go right to the end of it to look for it in case they buried the lead. But I think we'll be seeing a very, very clear statement and a commitment that they're going to keep fighting inflation until they start seeing it coming down back towards that 2 to 3% target band. So remaining very firm that that's their commitment to bring inflation down.
Thanks for that, Peter. We'll come back to you shortly, but it is now just gone 2:30, the time when the Reserve announces its decision. Alicia.
And as expected, the Reserve Bank has lifted the cash rate by half a percentage point, which now takes the official cash rate to 1.85%, the highest cash rate that we've had in Australia since April 2016. I mean, we had a period of a cash rate from about 2017 to late or mid rather 2020 when the pandemic hit of around 1.5% before it started being cut to those emergency levels. So we have to go back quite a bit of time to see a cash rate this high. Of course, Philip Lowe says he thinks that the neutral cash rate, and he doesn't want to specifically say, but could be around 2.5%. That's where the more sort of, I guess, measured economists are expecting the cash rate to end up by the end of the year.
So it's now a waiting game, isn't it, until we hear what the banks are going to do. How much of a hit will this be for mortgage holders?
Well, given that we have had this half a percentage point increase, if you look at an average mortgage, I suppose I'm going in the middle here. Some people have much larger mortgages, some people have much lower ones. But for $750,000 mortgage, we'll see an extra $211 per month for those who have to repay them. If you're looking at the combined interest rate rises over the last 4 months, that's an extra $708, as you can see on the screen. And for those who are perhaps in the bigger capitals like Sydney and Melbourne, who are more likely to have a mortgage of around $1 million, that's an extra $944,000 per month now with those rate hikes combined compared to what they would have been paying back in May. Of course, some people still have fixed rates and they will roll off those in the next year or so. But for those who are paying a variable rate, and this is averaged, that's the type of repayment increase we're seeing. So you can understand why the Reserve Bank is then monitoring the consumer sector so closely. Now, there is going to be probably more pain for mortgage repayers, if you like, given what I was mentioning before. The cash rate is likely to continue to rise if markets are correctly forecasting this. They're expecting by the middle of next year, or even just a bit earlier, about March 2023, that the cash rate will hit 3.3%. You can see that climb over the next 6 months or so to get to that level. Before it's anticipated, the Reserve Bank will have to start cutting interest rates in order to relieve some of the pain the economy may be feeling, taking it down to 3%. As I mentioned, some economists are more conservative in their views, but in any case, this is the market consensus forecast at the moment. And of course, if we look historically, we can see that the cash rate was sitting at around 1.5% before the pandemic. And this was, I guess, in part criticised by some economists for the Reserve Bank perhaps not cutting more to stimulate the economy in that period of time, but it certainly did give it room to cut during the pandemic. You can see there it taking the cash rate down to 0.1% before now that very steep climb higher, an extremely fast run up in interest rates, a really steep jump in the last 4 months.
So what are economists thinking about this latest move?
Well, economists are very likely to be very thankful that they have predicted this move, as it is very much in line with expectations. I think we're going to hear from the Reserve Bank on Friday with a statement of monetary policy, which will outline its inflation and growth forecasts, which are likely to be increased for inflation, perhaps lowered for growth. And then the flashpoint for the RBA will be the August wage price index on the 17th of August in 2 weeks' time.
So you mentioned that Philip Lowe was talking about a peak of interest rates at about 2.5%. There seems to be some disagreement as to whether that was going to be 2.5% or even 3% by the end of next year.
Well, there certainly is. I mean, look, he's talking about the neutral cash rate, the cash rate that should sustain the economy in the sweet spot, if you like. So that's where they're talking about a neutral cash rate. And so, I mean, look, we've got an economist standing by, so we might get his opinion now. Carlos Cacho is the chief economist at Jarden, and he joins us. Carlos, we've heard the market expectations for rates and how high they think they'll go, around 3.3%. How high do you think the RBA will push them?
Thanks for having me, Alicia. Look, our view is quite similar to the market at the moment. We recently upgraded it to a terminal cash rate of around 3.1% by the end of the year. We think that is going to be restrictive in the RBA's view. As you mentioned, the RBA thinks the neutral cash rate, which is the level of the cash rate, which is neither a drag or a benefit to the economy, is around 2.5%. And so we think that they'd like to get it into a restrictive territory by the end of this year, given they now expect inflation to peak at around 7.75%. So that's, well above their 2 to 3% range. So clearly they need to tighten policy to get that back towards that target.
And I mean, I mentioned the wages data in a couple of weeks' time. How important will it be for the RBA to see that not too high, but not too low?
I think the wages data is still quite important for more medium-term inflation expectations. In the short term, as you highlighted, a lot of the drivers are these supply chain issues, the price of energy, the price of construction costs. But in the medium-term outlook, it's really going to be about wages growth picking up that drives that fundamental kind of services-driven inflation that's much more persistent. To date, we haven't really seen much of an increase in wages in the official measures, but the RBA has repeatedly reiterated that they're hearing more and more or signs of wage growth from their business liaison. So it does seem like they're putting quite a lot of weight in that. And we're certainly hearing it from companies, and I expect we'll hear a lot more of it in the coming weeks in the reporting season, and seeing it in business surveys like the NAB survey, where wages are the number one concern for businesses at the moment.
Especially given the skills shortage that we have been talking about. But beyond the employment situation, is there a risk that the RBA might go too far here and really hurt the consumer sector, which we know is much more heavily indebted than it was when interest rates were at this type of level or even higher a decade or so ago?
Yeah, look, a policy error is, an over-tightening, if you will, is definitely a risk. We're seeing the fastest pace of rate hikes since 1994. We expect that by the end of this year, it'll be the fastest pace of rate hikes since 89, which would be, the fastest one of the inflation targeting regime. So we are moving at a very fast speed. The lags in the data mean that by the time we actually know we've gone too far, it might be too late. So it is going to be a challenge for the RBA to try and keep track of how things are going. They have reiterated again that they are going to be watching consumers carefully. But as you highlight, Australian households have a lot of debt. There's a lot of people who borrowed heavily over the last 2 years, expecting rates to remain relatively low. We know that when banks have assessed borrowers, they've used a buffer rate of most recently 3%, but prior to October last year, it was 2.5%, and that entire buffer is going to be gone by the end of this year. So really, you're going to have people who are definitely going to be having to pull in their discretionary spending, and we do expect consumption is going to slow quite materially as we go into next year, as households have to rein in those other areas of discretionary spending to afford the mortgage repayments.
And I mean, when you're talking about policy error, there has been a bit of criticism heaped on the Reserve Bank. The governor particularly, we've heard from economists like Warren Hogan basically saying that the RBA governor has made quite a serious mistake. So there's even claims on the front page of some tabloid newspapers that he should take a hike. What's your view of the handling of monetary policy over the last couple of years by the RBA?
I think we really need to go back in time and remember what was the outlook when the RBA was making these decisions during COVID. And I think if we think back to what we knew at the time, a very accommodative stance of monetary policy was certainly appropriate given the risks on the horizon. And there was talk of unemployment hitting 10%, 12% plus. So a 0% cash rate seemed quite reasonable in that context. If anything, I think the criticism early on was that the RBA was too slow to cut rates. We cut to 0.25 in March, and then at the second meeting in March, and then we went down to November later that year. If anything, you could argue early on they were a bit slow. Yes, maybe we should have started a bit earlier. It's not helped for the RBA the fact that we've got quarterly CPI, so we're a bit behind the rest of the world when we see these things coming. And for a period, it did look like we might be missing out on the on these inflationary pressures. But it turns out we're just a little bit late to the party. So I think. Yes, that maybe policy wasn't optimal in hindsight, but we've got to remember that it was kind of made with the information that was available at the time. And we've had really, going back over the last 2 years, a period of, to use the most overused word of the last 2 years, of unprecedented volatility of economic data. I cannot remember a time where you've seen these sorts of forecast revisions and volatility in the monthly and quarterly data releases. So, it's not an easy period to be making big policy decisions like this in.
Indeed, Carlos Cacho, thank you so much for your time. And Ros, as Carlos was kind of pointing to, it is a really tough job. I don't know that I'd want to be the RBA governor right now.
Carlos also pointing out the wages data really will be key to knowing what the Reserve is likely to do next.
Yeah, absolutely. And as I mentioned, we'll get that on the 17th of August. So we will be watching that very closely, as will many economists.
Alicia, thank you. For now, we're taking you back to Parliament, where Treasurer Jim Chalmers has been responding to news of this interest rate hike.
Speaker, it's another difficult day for Australian homeowners with a mortgage. The Independent Reserve Bank has just announced its decision to increase interest rates by another 0.5%, bringing the cash rate to 1.85%. Now, Australians knew that this was coming, but it won't make it any easier for them to handle. This cycle of interest rate rises began before the election in response to inflationary pressures that began accelerating at the beginning of this year. Now, average homeowners with a $330,000 outstanding balance will have to find about $90 a month more for repayments as a consequence of this decision today, on top of around $220 extra in repayments since early May. For Australians with a $500,000 mortgage, it's about an extra $140 a month, in addition to the extra $335 they've had to find since early May. Now, as I said, Mr Speaker, this decision doesn't come as a surprise. It's not a shock to anybody, but it will still sting. Families will now have to make more hard decisions about how to balance the household budget in the face of other pressures like higher grocery prices and higher power prices and the costs of other essentials. Now, obviously, higher interest rates primarily affect mortgage holders, but there's a broader economic impact as well. There's an impact on economic growth, which I talked about in the ministerial statement last week. And there's also an impact on the budget. It means that the $1 trillion of debt that the previous government left us gets even more expensive for us to service. Now, we've been upfront on this side of the House, Mr Speaker, about the growing challenges in our economy, because that's what Australians expect from us. They know that government changed hands at a time of high and rising inflation, rising interest rates, growing economic storm clouds, and $1 trillion of debt. And our job isn't to try and influence the Reserve Bank or to second-guess their decisions. Our job is to focus on what we can responsibly influence as a new government at the national level. And that's why the economic plan that the Prime Minister ran through a moment ago is a direct and deliberate response to these challenges that we have inherited. Responsible cost of living relief, addressing those issues on the supply side of the economy, and beginning to trim the budget of the rorts and the waste which are becoming more and more expensive for the Australian people to fund.
So that was Treasurer Jim Chalmers speaking in Parliament about the interest rate hike that's just been announced. Rates are going up by half a percentage point to 1.85% as expected. Let's go back to our senior business correspondent, Peter Ryan, who was outside the Reserve Bank. Hey again, Peter. So you've had a chance to take a look at that statement that comes with the rates announcement every month. What stood out for you?
Well, yes, Ros. I mean, further to what Jim Chalmers was saying just then in Parliament, a key factor for the Reserve Bank is how households are reacting to these rate rises, and yet another one today. The Reserve Bank is saying that households do have buffers, something like $250 billion worth of buffers to withstand these rising rates. That's fine if you're established in the market for a number of years, but for borrowers who've taken out a mortgage at the top of the market, perhaps bought in late 2021 when prices were surging, these rate rises are a significant problem. There will be households and families that will fall into mortgage debt. And this comes to the signal that Reserve Bank Governor Philip Lowe gave late last year when he said that most likely that the cash rate would stay low, near zero, at 0.1% until 2024. Not a pledge or a commitment, but speaking to economist Warren Hogan earlier today, concerns that there are some borrowers who took that very seriously and leveraged up big time and are now facing problems. So what happens with households? They're going to have to cut their spending. Consumption is a huge part of the economy, and when consumption stops, the economy cools, which goes to the theory that the Reserve Bank, having given themselves a higher rate level, will have to cut next year to put some life back into households.
We will be speaking to a debt expert very shortly about those issues that you've just raised. Peter, back to the statement though, any clues about future interest rate rises in there?
Yeah, and as we said before this announcement officially hit, the Reserve Bank has made the point that they want to see inflation back in that 2 to 3% target band. Inflation currently running at 6%. Headline underlying inflation is also very high in the 4s. And once again, this commitment that they will be doing what it takes to bring inflation down. So they're committed to that. And so you can lock in more rate rises later on this year, perhaps September, October and November, some market economists are predicting.
Alicia was referring to this a little earlier, Peter. There are always fears, of course, about the Reserve being too aggressive in lifting rates, that it risks stifling growth if it moves too far too quickly. What's your feeling about the pace and size of these increases?
Well, when you consider where the cash rate was, 0.1%, you might as well say zero before the May meeting, a couple of weeks out from the election, things were probably looking very positive for people with mortgages. But now we've seen 1.75 percentage point increase over the last couple of months. So this is going to be adding a lot to household borrowings and mortgage repayments. But they've had to move aggressively, Ros, because they were simply behind the curve in fighting inflation. Inflation, we could say, crept up behind them while they were waiting to see evidence of wages growth. So now no choice but to move very, very aggressively. And it's highly likely that in September there might be another half a percentage point increase, depending on how the futures markets regard this. So I wouldn't be putting any solace in thinking that the Reserve Bank might be backing off, thinking that there might be a recession a bit later on. They know that's probably a risk. They'll have to deal with that, but we'll be seeing a higher rates environment right through to the end of the year, possibly even in early 2023.
Okay, Peter, thank you. So we've looked at the economy, market reaction to today's rates, but what about the impact on consumers and on people who are already struggling to make ends meet? Dr. Dominic Merrick is from Financial Counselling Australia, and she's here with her thoughts. Hi, Dominic. So another interest rate rise today, the fourth in as many months. Have you seen an increase in traffic of people coming to you for help and advice about money?
Yes, thanks for having me, Ross. We are seeing an increase in people calling in with cost of living related issues, things like mortgage stress, and we know that the interest rates are passed on to renters, so high levels of rental stress. people struggling to pay utility and electricity bills, people struggling to pay petrol, and of course all these things compounding together to make basic things like food and everyday cost of living items really difficult to manage. So this interest rate lift, although expected, will be causing further levels of stress and anxiety on people who are already struggling.
Can you outline what are the most common questions and problems that people have at the moment?
Yeah, as I said, mortgage stress and rental stress seem to be high on the list of things that people are really worried about. Also, meeting electricity and gas situation. So when there's a whole number of issues compounding together, the question of how to manage those existing debts, and also when you're, particularly if you're on quite a low or a fixed income, how to cut the costs, what happens around discretionary spending. And you can do things like making sure that you haven't got subscriptions that you're not paying for, or making sure you're managing your food budget and that type of thing. But at the end of the day, you've kind of got to stretch what's there across really quickly increasing prices.
Dominique, we've heard anecdotal evidence about people paying for essential items like food on buy now, pay later services. Is that something you've encountered too?
Yeah, buy now, pay later presents, when people are already struggling, presents a number of risks to people. We would strongly encourage people not to take on any further debt in order to manage existing debts. And that includes using buy now, pay later products.
So with the prospect of rates rising further, you've mentioned a couple of moves that people can make. What really can people do to get through their immediate financial future?
Yeah. So one of the big things to do is to make sure that people are shopping around for the everyday costs that are just going to be ongoing. So things like picking up the phone and speaking to your bank, having a look around at what else is on offer and letting your bank know that you're looking around, asking for the best deal that you possibly can. Same goes for things like telcos and utilities, making sure that you're really on the best deal that you possibly can be, because we know that things are likely to get worse before they get better. So the more things you have in place in an ongoing way, the better. That would be one. The other thing is to make sure that you're aware of and you're utilising any concessions that you might be entitled to. Again, this usually would involve calling a service provider to see whether there are any concessions that could apply in your situation. So those would be two of the big things.
Yeah, sorry, Dominique, I was going to ask you how accommodating are organisations if consumers get in touch with them to say that they're having trouble paying a bill or who just haven't got the money at the moment to pay?
The big message there is act sooner rather than later. So banks and utilities and all sorts of service providers have hardship teams. Pick up the phone. If you're having trouble paying your bills now, pick up the phone and tell them sooner rather than later. They have hardship departments whose job it is to help. If having had that conversation, you're still feeling overwhelmed or it hasn't got to a solution that is workable, the next thing to do is call a financial counsellor. So financial counsellors will provide free and impartial advice and help you to advocate for yourself or to advocate on your behalf. You can do that by calling the National Debt Helpline on 1800 007 007.
All right, Dr. Dominique Merrick, thank you so much for speaking to us today.
It's been a pleasure. Thank you, Ros.
Well, there are also implications, of course, for renters across the country of the interest rate rises. This graph shows the national median cost of rent over the last 12 years. As you can see, after a drop at the start of the pandemic, rent has been rising rapidly, almost 10% in the past 12 months. That's despite house prices fluctuating over the last decade. The latest data shows house prices are falling at the fastest pace since the global financial crisis, but that's unlikely to bring much relief to renters. With more on the rental situation, here's Jennifer Beveridge, who is a spokesperson from the Tenants Union. Hi, Jennifer. So there's a clear link, isn't there, between increasing mortgage rates and rents going up. What have you been hearing about how people have been coping with that?
Well, I guess two things to start with. One, about 30% of Australians rent their home. So we're not talking about a small proportion of people, we're talking about a significant proportion of Australians who live in rented homes. The other thing that we're hearing, and we know anecdotally and in the data, is that renters are generally on lower incomes than people who have either bought or are buying their homes. So as your previous guest mentioned, sometimes there's just not a lot of money to go around, and in times like this it does get harder for renters to make ends meet.
Yeah, and what sort of rent rises have you heard about, Jennifer?
Well, you've indicated there that 10% across the board. We're hearing as high as 20% in some areas. Those areas that are particularly where people have moved during the pandemic, and so the demand is high and the vacancy rates are low. So it's really a landlord's market in these circumstances. And if you think about 20% on a rent that is $400 a week, that's $80 a week extra that people have to find.
So is there no limit then on the amount that a landlord can put up rents by?
Across Australia, each state and territory has different requirements. For example, here in Victoria, the rent can only be increased once a year, and there are some guidelines around how that is calculated. In other areas like the ACT, there's a number that is able to be calculated, and that's applied. Every jurisdiction or every state or territory has some guidelines about what's fair and what's reasonable. And so if people are finding that the rent is being increased too much, I'd really encourage them to seek some advice. The tenants union in each state, or the tenant organisation in each state, or the equivalent of Consumer Affairs will be able to provide some information on that.
And it's not just rising rents, is it? Often there seems to be the problem that people move out of a place because the rent is too high and then can't secure another because just competition for places that there is out there.
That's right. Well, with a vacancy rate at the moment of less than 1%, things are really tough. And so for every house, there are more and more people who are applying to move into that place. As I said earlier, there are some areas that people have moved to during the pandemic, and that means that there's even less availability for those who are looking for a home to rent for themselves and their family. So we would really encourage people not to just give up. The moment that things get bad, talk to your property manager, talk to your landlord, or your rental provider, explain your situation. If you've been a good tenant and you're there for the long term, there's value in that for rental providers to keep you in the house that they own, that you have turned into your home.
Jennifer Beveridge, thank you for all that advice.
Thank you very much.
Let's get final thoughts now from our senior business correspondent, Peter Ryan, who's outside the Reserve Bank. Hi again, Peter. So we've been hearing that inflation is being pushed up in large part. But what's happening overseas and supply constraints? So how will raising rates here affect what's happening overseas?
Well, we are like a small cork floating around in the ocean, subject to what's happening in Ukraine, what's happening in the United States. We saw the United States go into a technical recession last week, though not an official one, because that's another decision that's made by another body. But that's right. I mean, inflation here in Australia, big inflation in the United States. We are quite hostage to what Vladimir Putin does. Will he cut off gas supplies to Europe, which would be a real flashpoint for inflation? And I was just listening to your previous guest there about mortgage stress. The message from the big banks is that they haven't been hearing too much about mortgage stress at the moment, but want people or borrowers to get in touch with banks as soon as they experience any difficulty in meeting their repayments, because it's obviously not in the interest of banks for people to default on their home loans. And remember, during the pandemic, the banks acted very swiftly with loan repayment deferrals to ensure people's properties were maintained and repayments were made. So there are a lot of options for people who might be feeling under pressure at the moment.
One thing we haven't mentioned so far, Peter, is the independent review of the operation of the Reserve Bank that was announced by the government. Will that have any influence on the bank's decisions moving forward, given the implication that it has let inflation get out of control?
Well, that's right. This review was announced last week by the Treasurer, Jim Chalmers. It's going to be looking at a range of things, culture, governance, communications, what happens in the boardroom upstairs at the Reserve Bank board, how they reach their decisions, how the board is comprised. There is some criticism that it's too heavy on business leaders and economists and academics. And Treasurer Jim Chalmers has already said perhaps even there should be representation from the union movement on that board. So there are some big, wide open possibilities in this review.
OK, Peter Ryan, our business correspondent down there in Sydney CBD outside the Reserve Bank. Thank you. Well, that's where we'll leave our special coverage of today's interest rate rise. The Reserve Bank pushing up the official cash rate by half a percentage point to 1.85%. Remind you can keep up to date on all the latest news across all your devices at news.abc.net.au and on ABC iView.